What is the difference between value and growth? Isn't the growth and internet stocks riskier? Aren't the growth in internet stocks riskier?
So this is a good question. This is a two-part question. I mean, first of all, by definition, there's risk whether you buy value stocks or growth stocks. So let's be sure we're all on the same page here, right? Just because you buy a value-based stock doesn't mean there's no risk. It's just a way for you to build a plan that if you compile value stocks as an example with growth stocks, you have a ability to avoid or help avoid a permanent loss of capital. It just builds in a margin of safety to your portfolio, so you have assets on both sides of the fence if it makes sense for your plan based on your goals and objectives. Now, as far as growth is concerned, just to kind of talk for a second about the difference between value and growth. If you think about growth stocks are consistent with what their future earnings are. And so you may see some of these growth stocks today reducing their future expected earnings because of one reason or another. And it's based on valuations that ultimately will be in the future. And they'll be assumed by if they hit their margins for whatever it is that they anticipated, trying to get from a stock market perspective. So they take all the money that they earn and they pour it back into their business to buy and make bigger and better widgets, for example. But on the value side, you have a company that is designed to take their cash flow and pay back compensation to their shareholders in form of a dividend payment. And so Caterpillar is an example of that, where Caterpillar takes revenue that they make as a company and they pour it back out to the shareholders in form of a dividend payment. And so that is the core definition or understanding of the differences between those two. And you can see that if we're currently getting cash flow from a dividend that's based on earnings today versus what the future earnings of a potential growth stock could be, ideally, if you have the ability to absorb risk and you have the time horizon to do this, it might be best suited for you to have a little bit of both of these things in your overall portfolio to try to help manage your overall risk.